Hello everyone, welcome to another episode of Financial Tidbits here with me, Royston at NOF. As you can already see from the title of this video, we will be talking about one of the best airlines in the world today and how they have actually mastered the art of financial engineering. Now, this is a pretty controversial topic and I'm not insinuating that SIA is doing anything illegal or fraudulent. How can a government-linked entity be doing anything above the law? Am I right? Okay, a little bit of context over here, as some viewers might not be aware of what exactly is going on with SIA. If you look at its share price, you'll probably assume that everything is going swimmingly well for the company, with the company rewarding shareholders with tons of profit. But the hard truth is that the company just recently reported one of its worst financial performance in the history of the company, losing 4.3 billion in its last financial year ending 31st March due to COVID-19. Well, at this juncture, you might be highlighting, hey Royston, those are water under the bridge and things will be so much rosier in the coming months. Anyway, besides announcing the supposed one-off mega losses for its fiscal year 2021, SIA added that it will be raising additional funds by tapping onto its MCB or Mandatory Convertible Bonds issue. This allows the company to raise another 6.2 billion of shareholders' money. Now, this is an ingenious move on the part of SIA, if I may say, and looks to be the apex of financial engineering. Again, nothing illegal over here, but let me explain what is going on. You see, when a listed company looks to raise money for its business, there are typically two options. Number one, you go to the bank and say you wish to take a loan. The bank, who most should know by now is your fair weather friend, will take a look at your balance sheet and see if you are already drowning in debt. If so, they'll likely show you the exit. But if your balance sheet is clean, they'll welcome you with open arms and treat you like their best buddy that you have known for decades. If you're linked to the government, you're probably going to get the VIP treatment. So this is the debt route. You raise cash, but at the same time increase your financial liability as this debt needs to be repaid down the road. The second option is to raise money from the market. This means going to your shareholder and say, show me the money. To raise money from your shareholders, typically that means issuing new shares to them. So now you are raising cash, but instead of increasing your financial liability, you are increasing this component called shareholders' equity. Now, this is generally a better option as you want your company's equity base to keep growing. The only problem, and a major one if I may say, is that the issuance of new shares, there is going to be a dilution effect. Take for example, if SIA generates 1 billion in profit and it has an outstanding share base of 1 billion shares, before the equity raising, the earnings per share of the company, or EPS for short, is 1 billion in profits divided by 1 billion shares, equals to $1 per share. Now, after the fundraising, SIA gets cash, but now its share base becomes 2 billion shares. If SIA generates the same amount of profit of 1 billion, the EPS will now be 1 billion in profits divided by 2 billion shares, which equates to 50 cents per share in EPS. That is the dilution effect in play. Now, during the peak of the COVID-19 crisis back in early 2020, SIA's management was probably thinking, now, how can we raise capital without, number one, increasing our debt profile, while number two, increasing our equity base to make our balance sheet even more robust, and number three, not result in any form of shareholders' dilution? The light bulb moment lit up when they came up with the product Mandatory Convertible Bond, which is now widely known as MCBs to Singaporeans. Prior to SIA revolutionizing this financial product, who the hell have heard of MCBs? So, What they have used is this financial product that allows them to raise capital by allowing shareholders to convert their rights into bonds by paying a sum. Now, the money is in SIA pocket, which is fantastic. Typically, bonds are considered as a financial liability, and that increases your debt level. But these MCBs, instead of being classified as a liability, are being classified as equity. So it acts just like an equity raising. But remember, I previously mentioned that the major downside with equity raising is that it will result in massive dilution effect. For the MCBs, there is minimal dilution effect from now until 2030. The huge dilutive effect will only occur in 2030 if SIA chooses not to redeem back the bonds. Only then will it be converted into shares. But frankly speaking, who cares about 2030? It is all about what is happening right now. Guys, do you see the ingenuity in that move? What is happening now is that SIA is getting a free lunch that has no immediate negative consequences to shareholders. They raise cash, there is no increase in debt, it raises their equity level, which makes their balance sheet even more robust, and they can now go to the banks and say, hey, lend me more money. Look, I've got so much more equity in my balance sheet. And more importantly, there is no dilution effect to shareholders, at least for now. So while I personally feel the market is short-sighted to ramp up SIA share price on the back of improved fundamentals, I've got to salute SIA's inventiveness in using such a financial product. Again, this is my own personal opinion, and it is up to you to judge if SIA is indeed worthy of your investment. Once again, if you do enjoy the video, do hit the like button and sign up for the NUF YouTube channel. This is Royston, signing out.